In the morning of September 3rd, 1958, the following cable arrived at the Gloucester Hotel in the Crown Colony of Hong Kong. Bought 3,000 thiacol, 49 7/8. This purchase represented one part of a chain of purchases that were to net $2 million in 18 months. And this is the story of events that led up to it. Chapter 1. Canadian Period. It was November 1952. I was playing in Manhattan's Latin Quarter in New York when my agent telephoned. He had received an offer from me and my dancing partner, Julia, to appear in a Toronto nightclub. This was owned by twin brothers, Al and Harry Smith, who made me a very unusual proposition. They offered to pay me in stock instead of money. I've had some strange experiences in show business, but this was a new one. I made further inquiries and found they were prepared to give me 6,000 shares in a company called Bryland. This was a Canadian mining firm in which they were interested. The stock at that time was quoted at 50 cents a share. I knew stocks went up and down. That was about all I did know. So I asked the Smith brothers if they would give me the following guarantee. If the stock went below 50 cents, they would make up the difference. They agreed to do this for a period of 6 months. It so happened that I could not keep that Toronto date. I felt badly about letting the brothers down, so I offered to buy the stock as a gesture. I sent them a check for $3,000 and received 6,000 shares of Bryland stock. I thought no more about it until one day, 2 months later, I idly glanced at the stock's price in the paper. I shot upright in my chair. My 50-cent Bryland stock was quoted at $1.90. I sold it at once and made a profit of close to $8,000. At first, I could not believe it. It was like magic to me. I felt like the man who went to the races for the first time and with beginner's luck backed every winner. Cashing his winnings, he simply inquired, "How long has this been going on?" I decided I had been missing a good thing all my life. I made up my mind to go into the stock market. I have never gone back on this decision, but little did I know what problems I would encounter in this unknown jungle. I knew absolutely nothing about the stock market. I was not even aware, for instance, that there was one in New York. All I had heard about were Canadian stocks, particularly mining shares. As they had been very good to me, obviously the smart thing to do was to stay with them. But how to start? How to find what stocks to buy? You couldn't pick them out with a pin. You must have information. That was my major problem. How to obtain it? I now realize that this is, in fact, impossible for the ordinary man. But then I thought I had only to ask enough people to learn the great secret. I thought if I asked often enough, I would get acquainted with people in the know. I asked everybody I met if they had any stock market information. Working in nightclubs, I meet rich people. Rich people must know. So I asked them. The question was always on my lips. Do you know a good stock? Oddly enough, everybody did seem to know one. It was surprising. Apparently, I was the only man in America who did not have his own first-hand stock market information. I listened eagerly to what they had to say and religiously followed their tips. Whatever I was told to buy, I bought. It took me a long time to discover that this is one method that never works. I was the perfect pattern of the optimist, clueless small operator who plunges repeatedly in and out of the market. I bought stock in companies whose names I could not pronounce. What they did and where they came from, I had no idea. Someone told someone who told me. There could have been no more slap-happy, ignorant buyer than I was. All I knew was what the last head waiter in the last nightclub I had performed in had told me was good. Early in 1953, I was performing in Toronto. Because of my first extraordinary $8,000 break with Bryland, Canada was the land of financial milk and honey as far as I was concerned, so I decided this was a good place to go looking for a hot tip. I asked several people if they knew a good, reliable broker, and eventually I was recommended to one. I must admit I was startled and disappointed when I found his office. It was a tiny, dingy, prison-like room full of books, with strange scrawls on the walls. Later I found out that these are called charts. There did not seem much smell of success or efficiency. Sitting at a roll-top desk was a busy little man poring over statistics and books. When I asked him if he knew a good stock, he reacted at once. He smiled and pulled out of his pocket a dividend check bearing the name of a famous gold company, Kerr Addison. He stood up and said, "My friend, take a good look at that. That dividend check is worth 5 times what my father paid for the original stock. That is the sort of stock everyone looks for." A dividend 5 times the price of the original stock? This excited me as it would any man. The dividend was 80 cents, so his father must have paid only 16 cents for the stock. It looked beautiful to me. I didn't realize he had probably been holding his father's stock for 35 years. The little man described to me how he had been looking for that kind of stock for years. In view of his father's success, he felt the answer must be in gold mines. He confided to me that he had at last found it. It was called Eastern Malartic. Working with his production figures, estimates, and financial information, he reckoned that these gold mines were capable of twice their present gold production. Therefore, $5 invested in their stock would soon be worth $10. On this piece of erudite information, I immediately bought 1,000 shares of Eastern Malartic at 290 cents. As I watched anxiously, it went to 270 cents, then to 260. Within weeks, it was down to 241 cents, and I hastily sold my stock. I decided this painstaking, statistically minded broker did not have the answer to making a fortune. Yet the whole thing continued to fascinate me. I went on following any tip, but I seldom made money. If I did, it was immediately offset by my losses. I was such a novice that I did not even understand about broker's commission and transfer taxes. For instance, I bought K-Rand Mines in January 1953. It was a 10-cent stock, and I bought 10,000 shares. I watched the market like a cat, and when next day K-Rand went to 11 cents per share, I called my broker and told him to sell. By my reckoning, I had made $100 in 24 hours, and I thought I was being smart by taking a quick, small profit. When I talked to my broker again, he said, "Why did you decide to take a loss?" A loss? I had made $100. He gently explained to me that the broker's commission for buying 10,000 shares was $50, and for reselling the shares next day it was another $50. In addition, there were transfer taxes on the sale. K-Rand was just one of the many strange stocks I owned at that time. Others included Mogul Mines, Consolidated Sudbury Basin Mines, Quebec Smelting, Rexpar, J Exploration. I made money on none of them. Yet I spent a happy year on this Canadian buying and selling. I felt I was the successful businessman, the big stock market operator. I jumped in and out of the market like a grasshopper. I was delighted if I made 2 points. I often owned 25 to 30 stocks at one time, all in small parcels. For some of them, I acquired a special liking. This came about for different reasons. Sometimes it was because they were given to me by a good friend of mine, other times because I had started by making money with them. This led me to prefer these stocks more than others. And before I knew what I was doing, I had started to keep pets. I thought of them as something belonging to me, like members of my family. I praised their virtues day and night. I talked about them as one talks about his children. It didn't bother me that no one else could see any special virtue in my pet stocks to distinguish them from any other stocks. This state of mind lasted until I realized that my pet stocks were causing me my heaviest losses. In a few months, my record of transactions looked like the trading record of a small-scale stock exchange. I felt I was doing all right. I appeared to be ahead. If I had carefully studied my statements, I would not have felt quite so happy. I would have realized that, like a horse player, I was buoyed up and excited by small gains and overlooked my losses. I completely ignored the fact that I was holding a lot of stock which was standing well below the price I had paid for it and looked like it was staying there. It was a period of wild, foolish gambling with no effort to find the reasons for my operations. I followed hunches. I went by God-sent names, rumors of uranium finds, oil strikes, anything anyone told me. When there were constant losses, an occasional small gain gave me hope, like the carrot before the donkey's nose. Then, one day, after I had been buying and selling for about 7 months, I decided to go over my books. When I added up the values of the bad stocks I was holding, I found I had lost almost $3,000. It was on that day that I began to suspect that there was something wrong with my money-making scheme. A ghost at the back of my mind began to whisper to me that, in fact, I had no idea what I was doing. Yet I was still ahead. I consoled myself that I had not touched the $3,000 I had originally paid for Bryland. And I had about $5,000 of my profit from that transaction besides. But if I continued like this, how much longer would I keep it? Here is just one page from my profit and loss accounting. It tells the whole sad story of defeat in microcosm. Old Smoky Gas and Oils, bought at 19 cents, sold at 10 cents. K-Ran Mines, bought at 12 cents, sold at 8 cents. Rexbar, bought at 130 cents, sold at 110 cents. Quebec Smelting and Refining, bought at 22 cents, sold at 14 cents. Obsessed by my carrot before the nose gains, I had not noticed I was losing an average of $100 a week. It was my first stock market dilemma. The market had several much more serious dilemmas in store for me in the next 6 years, but this one was in some ways the worst. On my decision at this point depended whether I would continue to operate in the market. I decided to stay and have another try. The next problem was what to do. There must be a different way. Could I improve my approach? It had been proved to me that it was wrong to listen to nightclub customers, head waiters, stagehands. They were only amateurs like myself, and however confidently they offered their tips, they did not know any more than I did. I gazed at page after page of my brokerage statements, which said, bought 90 cents, sold 82, bought 65 cents, sold 84. Who could help me to discover the secrets of the stock market? I had started to read Canadian financial publications as well as Canadian stock tables. I had begun increasingly to glance at advisory news sheets, which gave tips about stocks listed on the Toronto Stock Exchange. I had already decided that if I were to go on, I would need professional help, so I subscribed to some advisory services which gave financial information. After all, I reasoned, these were the experts. I would follow their professional advice and quit buying stock on the odd tip from a stranger or an amateur stock fancier like myself. If I followed their skilled, sensible teaching, I must succeed. There were financial advisory services that offered a trial subscription of 4 copies of their information sheets for $1. You could have these as a goodwill taste before you began seriously to buy their valuable service. I put down a dozen or so dollars for trial subscriptions and eagerly read the sheets they sent me. In New York, there are reputable financial services, but the Canadian sheets that I bought were strictly for the sucker trade. How was I to know this? These financial advice sheets delighted and excited me. They made stock market speculation sound so urgent and easy. They would come out with huge headlines saying, "Buy this stock now before it is too late. Buy to the full extent of your resources. If your broker advises you against it, get rid of your broker. This stock will give you a profit of 100% or more." This, of course, seemed like real, red-hot information. This was much more authentic than the odd tip picked up in a restaurant. I read these promotion sheets eagerly. They were always filled with much unselfishness and brotherly love. One of them said, "For the first time in the history of Canadian finance, the little fellow will have the fantastic opportunity of getting in on the ground floor of a brilliant new development. The plutocrats of Wall Street have been trying to acquire all the stock in our company. But in clear defiance of the evil traditions, we are only interested in the participation of investors of moderate means, people like you." But this was me. They understood my position exactly. I was the typical little fellow to be pitied for the way he was pushed around by the Wall Street plutocrats. I should only have been pitied for my stupidity. I would rush to the telephone to buy the stock they recommended. It invariably went down. I could not understand this. But I was not the slightest bit worried. They must know what they're talking about. The next stock must go up. It seldom did. I didn't know it, but I was already coming up against one of the great pitfalls of the small operator, the almost insoluble problem of when to enter the market. These sudden drops immediately after he has invested his money are one of the most mystifying phenomena facing the amateur. It took me years to realize that when these financial tipsters advise the small operator to buy a stock, those professionals who have bought the stock much earlier on inside information are selling. Simultaneously with the withdrawal of the inside track money, the small sucker money is coming in. They are not the firstest with the mostest, but the lastest with the leastest. They are far too late, and their money is always too small to support the stock at its false high point once the professionals are out. I know this now, but at that time I had no idea why stocks behaved like that. I thought it was just bad luck that they dropped after I bought them. When I look back, I know that I was all set at this period to lose everything I had. When I did invest $100, I almost always lost $20 or $30 at once. But a few stocks did go up, and I was comparatively happy. Even when I had to go to New York, I continued to telephone my orders to brokers in Toronto. I did that because I did not even know you could transact Canadian Stock Exchange business through a New York broker. The Toronto brokers would telephone tips, and I always bought the stock they or the Canadian Financial Advisor Services suggested. Like all small hit-and-miss operators, I put down my losses to bad luck. I knew, I was certain, that one day I would have good luck. I was not wrong all the time. In some ways, it would have been better if I had been. Once in a while, I made a few dollars. It was always a complete accident. Here's an example. The Canadian stock tables had become obsessive reading with me. One day, when I was looking through them, I saw a stock called Calder Bosket. I still don't know what it was or what the company produces, but it was such a pretty name. I liked the sound of it. So I bought 5,000 shares at 18 cents for a total of $900. Then I had to fly to Madrid on a dancing engagement. 1 month later, when I came back, I opened the paper and looked for the name. It had gone up 36 cents. That was double the price I had paid. I sold it and made $900. It was just blind luck. It was doubly blind luck because not only had it gone up for no good reason, but if I had not been dancing in Spain, I would have certainly sold the stock when it rose to 22 cents. I couldn't get Canadian stock quotations while I was in Spain, so I was saved from selling too soon by being in blissful ignorance concerning the stock's movements. This was a strange, mad period, but it only seems so in retrospect. At that time, I felt I was really beginning to be a big-time operator. I was proud of myself because I was working on tips of a more educated nature than my previous headwaiter dressing room information. My Canadian brokers called me, my financial services advised me, and if I did get a tip, I felt I was getting it from the source. I cultivated more and more the society of prosperous businessmen in cocktail lounges who told me about oil companies which were going to strike it rich. They whispered where there was uranium in Alaska. They confided about sensational developments in Quebec. All these were guaranteed to make a great fortune in the future, if you could only get into the stocks now. I did, but they did not make me any money. By the end of 1953, when I returned to New York, my $11,000 was down to $5,800. Once again, I had to reconsider my position. The businessmen's tips did not produce the El Dorado they promised me. The advisory services did not provide the information which enables you to make money in the stock market. Their stocks tended much more to go down than up. I could not get quotes for some of my Canadian stocks in the New York newspapers. Yet stock quotations fascinated me so much that I began to read the financial columns in papers like the New York Times, the New York Herald Tribune, and the Wall Street Journal. I didn't buy any of the stocks that the New York exchanges quoted, but I still remember the impact of beautiful names of some of the stocks and the appeal of some of the mysterious phrases like over-the-counter. The more I read, the more I became interested in the New York market. I decided to sell all my Canadian stock except for Old Smoky Gas and Oils. And I kept this one because the man who gave me the stock in the first place advised me that fantastic developments were expected. As usual, no fantastic developments took place, and after 5 months in New York, I gave up the unequal struggle. I sold my last Canadian stock, which I bought for 19 cents, for 10 cents. In the meantime, I had begun to wonder if the bigger jungle nearer home, the New York Stock Exchange, would not be easier to assail. I called a friend of mine, a New York theatrical agent, Eddie Elcourt, and asked him if he knew a New York broker. He gave me the name of a man whom I will call Lou Keller. Chapter 2. Entering Wall Street. I called Lou Keller. I told him who I was and what I wanted. Next day, he sent me some papers to sign and advised me that as soon as I returned them with a deposit, I would have an account with his brokerage firm. When I received his notice, something happened to me. Suddenly, I began to feel that I was becoming part of the financial scene. I cannot describe Wall Street because I have never been there physically, but even its name had an almost mystical attraction for me. Here, everything was going to be serious and different. I now consider my Canadian induction period as pure crazy gambling that I would never repeat. As I studied the long gray columns of stock market quotations in the New York papers, I felt I was about to enter a new and successful period in my life. This was not like the wildcat Canadian market with its quick tip-offs on gold strikes and uranium fields. This was responsible business, the street of bank presidents and great industrial combines, and I prepared to enter it with proper reverence. I intended to make a much more cautious and mature approach to the stock market. I added up my assets to see what I had to work with. I started in the Canadian market with $11,000, my original Bryland investment of $3,000, and profit of $8,000. This had been reduced by $5,200 in the 14 months of my Canadian operations. All I had left of the Bryland money was $5,800. This did not seem like enough money with which to approach Wall Street, so I decided to add to it. From the savings of my show business activities, I raised my stake to $10,000. It was a good round figure, and I deposited this sum with the broker. Then one day I decided to start trading. I rang Lou Keller and nonchalantly, trying to be the old financial hand, simply asked him what was good. I realize now this inquiry was more suitable for a butcher, but Mr. Keller was equal to it. He suggested several safe stocks. He also gave me the fundamental reasons why these stocks were safe. While I did not understand, I listened intently to such explanations as dividend increase, stock splits, improved earnings. Now this, to me, was the highest professional advice. This man earned his living on Wall Street, so obviously he knew. Besides, he only suggested. He emphasized that the decision was up to me. This made me feel important and in command. When one or two of the stocks he gave me rose a few points almost immediately, I had no doubt of the excellence of the information I was receiving and my natural ability as a stock market operator to act on it. What I did not know was that I was practically smack in the middle of the biggest bull market the world had ever seen, and it was quite difficult, unless you were extremely unlucky, not to show a little paper profit from time to time. Here are 3 typical consecutive deals I concluded in the early part of 1954, deals which convinced me I was a natural in Wall Street. In this table, as in all the following tables in this book, I have included commissions and trades. 200 Columbia Pictures, bought at $20, $4,050, sold at 22 7/8, $4,513.42. Profit, $463.42. 200 North American Aviation, bought at 24 1/4, $4,904.26, sold at 26 7/8, $5,309.89. Profit, $405.63. 100 Kimberly Clark, bought at 53 1/2, $5,390.35, sold at 59, $5,854.68. Profit, $464.33. Total profit, $1,333.38. You will note that each of these transactions netted me just over $400. It was not a large sum, but 3 profits in a row amounting to $1,338.38 in just a few weeks made me feel that these were smooth, simple operations and I was in control. The feeling that I was operating with a profit in Wall Street, allied to a natural all of the place, made me feel foolishly happy. I felt I was losing my Canadian amateur status and becoming a member of an inner circle. I didn't realize my method hadn't improved, that I was simply using more pompous words to cover it. For instance, I no longer considered the broker's advice as tips, but as information. As far as I was concerned, I had given up listening to tips and instead was receiving authentic news based on valid economic evidence. The boat sailed happily along. Here are some of my transactions during April and May 1954. National Container, bought 11, sold 12 3/8. Tricontinental Warrants, bought 5 1/8, sold 6. Alice Calmers, bought 50 3/4, sold 54 7/8. Bucyrus Erie, bought 24 3/4, sold 26 3/4. General Dynamics, bought 43.5, sold 47 1/4. Mesta Machine, bought 32, sold 34. Universal Pictures, bought 19 5/8, sold 22 3/4. Profits, profits, profits. My confidence was at its height. This was clearly not Canada. Here, everything I touched turned to gold. By the end of May, my $10,000 had grown to $14,600. Occasional setbacks did not bother me. I regarded them as slight, inevitable delays in the upward climb towards prosperity. Besides, whenever a trade was successful, I praised myself. When I lost, I blamed it on the broker. I continued to trade constantly. I telephoned my broker sometimes 20 times a day. If I did not conduct at least one transaction a day, I did not feel I was fulfilling my role in the market. If I saw a new stock, I wanted to have it. I reached out for fresh stocks like a child for new toys. These transactions, in which I was involved in Wall Street around July 1954, will show the energy I expended for very small returns. 200 American Broadcasting Paramount, bought 100 at 16 7/8, $1,709.38, 100 at 17.5, $1,772.50, sold at 17 7/8, $3,523.06, profit $41.18. 100 New York Central, bought at 21.5, $2,175.75, sold at 22.5, $2,213.70, profit $37.95. 100 General Refractories, bought at 24 3/4, $2,502.38, sold at 24 3/4, $2,442.97, loss of $59.41. 100 American Airlines, bought at 14 3/4, $1,494.75, sold at 15, $1,476.92, a loss of $17.83. Total profit $79.13. Total loss $77.24. My net profit on these transactions was $1.89. The only person who was happy was my broker. According to the New York Stock Exchange rules, his commission on these 10 transactions amounted to $236.65. Incidentally, my $1.89 profit did not include the price of my telephone calls. In spite of this, only one thing really bothered me. Half the words my broker used concerning the stock market I did not understand. I didn't like to show my ignorance, so I decided to read up on the subject. In addition to the financial columns in the New York daily papers, I began to read about the stock market so I could talk on his level. Slowly, I became acquainted with a series of new words and was always trying to use them. I was fascinated by words like earnings, dividends, capitalization. I learned that per-share earnings means the company's net profit divided by the number of shares outstanding, and that listed securities are those stocks that are quoted on the New York and American stock exchanges. I labored over definitions of stocks, bonds, assets, profits, yields. There was plenty to read, because there are hundreds of books published about the stock market. More has been written about the stock market, for instance, than about many cultural subjects. At this time, I studied books like R.C. Effinger, ABC of Investing, Dyson Eitman, The Stock Market, B.E. Schultz, The Securities Market and How It Works, Leo Barnes, Your Investments, H.M. Gartley, Profit in the Stock Market, Curtis Dahl, Consistent Profits in the Stock Market, E.J. Mann, You Can Make Money in the Stock Market. Now, I am certain that the serious Wall Street analysts who prepared this glossy booklet had nothing but the highest intentions. But I must record, in the interest of the truth, that by the end of 1956, this stock was down to 5 3/4. About that time, I heard a saying which has been passed from mouth to mouth for generations in Wall Street, but to me was new. You cannot go broke taking profit. I was much impressed by this, and I was burning to put it into operation. This is how I did it. One of the market leaders early in February 1955 was Kaiser Aluminum. On my broker's recommendation, I bought 100 shares at 63 3/8, paying $6,378.84 for the stock. It went up steadily, and at 75, I sold it. I received $7,453.29, which gave me a profit of $1,074.45 in less than 1 month. Hoping for another quick profit, I switched into 100 Boeing at 83. I paid $8,343.30 for these shares. The stock almost immediately began to drop. 4 days later, I sold at 79 7/8 for $7,940.05. My loss on the Boeing transaction was $403.25. Trying to make up for the loss, I then bought Magma Copper in the first week of April. It was selling at 89 3/4. I paid $9,018.98 for 100 shares. No sooner did I buy than it started to drop. 2 weeks later, I sold it at 80.5 for $8,002.18. This gave me a loss of $1,016.80. By this time, Kaiser Aluminum, which I had jumped out of in the first week of March, had moved up to 82. An advisory service was recommending it, so I switched back to it, buying 100 shares at that price. I paid $8,243.20. 5 minutes later, it started to slide. Not wanting to risk a further loss, I sold it at 81 3/4 and received $8,127.59. This meant that for 5 minutes of trading, I lost $115.61, including commissions. On the first Kaiser deal, I had made a profit of $1,074.45. The losses sustained by jumping in and out of the other stocks were $1,535.66. So the whole circular transaction, which began with Kaiser and ended with Kaiser, gave me a net loss of $461.21. If I had stuck with Kaiser from my original purchase at 63 3/8 until my ultimate sale at 81 3/4, I would have a profit of $1,748.75 instead of a loss of $461.21. Here's another case. From November 1954 to March 1955, I was constantly jumping in and out of a stock called Rayonier, which in the 8th-month period went from approximately 50 to 100. These were my transactions in Rayonier, 100 shares at a time. November to December 1954, bought at 53, $5,340.30. Sold at 58 1/4, $5,779.99. Profit, $439.69. February to March 1955. Bought at 63 7/8, $6,428.89. Sold at 71 5/8, $7,116.13. Profit, $687.24. March 1955. Bought at 72, $7,242.20. Sold at 74, $7,353.39. Profit, $111.19. Total profit, $1,238.12. The profit I made on this series of trades amounted to $1,238.12. Then the old loss pattern repeated itself. In April 1955, I switched into Manatee Sugar. I bought 1,000 shares at 8%, paying $8,508.80. Immediately afterwards, it started a downward slide, and I sold out at the varying prices of 7 3/4, 7 5/8, and 7 1/2. I received a total of $7,465.70, giving me a loss of $1,043.10. This left me with a net profit of $195.02 on the combined Rayonier-Manatee operation. However, if I had held my original November purchase of Rayonier without constantly trying to take a profit and sold it in April at 80, I would have had a profit of $2,612.48 instead of $195.02. What did all this mean? I didn't appreciate it at the time, but it was a classic refutation of, you cannot go broke taking a profit. Of course you can. Another stock market saying that began to fascinate me was, buy cheap, sell dear. This sounded even better. But where could I buy something cheap? As I searched for a bargain, I discovered the over-the-counter market, the market of unlisted securities. I knew from my books that in order to get its stock listed and traded on the stock exchanges, a company has to observe very stringent financial regulations. I had read that this did not apply to over-the-counter stocks. This market, therefore, seemed to me the perfect place to find a bargain. I naively believed that because these stocks were not listed, few people knew about them, and I could buy them cheap. I hurriedly subscribed to a monthly booklet called Over-the-Counter Securities Review and started hunting. I searched eagerly among the thousands and thousands of names from the bargains that seemed to be offered. I bought stocks like Pacific Airmotive, Collins Radio, Gulf Sulphur, Doman Helicopter, Kennametal, Tech Oil Corporation, and some of the more obscure ones. What I did not know was that when I came to offer them for sale, some of these stocks stuck to my fingers like tar. I found it very difficult getting rid of them, and rarely at anything like the price I paid for them. Why? Because there was no rigid price discipline as there is for the listed securities. There were no specialists, professionals to assure a continuous and orderly market. There were no reports where one could see at what price a transaction took place. There were only the bid and ask prices. These, I discovered, were often very far apart. When I wanted to sell at 42, which was the quoted ask price, I found only a buyer at 38, the quoted bid price. I sometimes ended up at 40, but that was by no means certain. When I stumbled into the over-the-counter market, all this was unknown to me. Fortunately, I quickly came to realize that this is a specialized field and is only lucrative for experts who really know something about the affairs of a particular company. I decided to give it up and return my attention to listed securities. All this time, I never once questioned the truth of any Wall Street rumors. I had no way of knowing that they are just as ill-founded and dangerous as rumors in the Canadian and other markets. What I believed to be solid information, piped straight from Wall Street, had the most sensational lure for me. Here are two typical cases that show the sort of information I gobbled up and acted upon. One day, a strong rumor floated into the market that Baldwin Lima Hamilton, a firm of railroad equipment manufacturers, had received an order to construct an atomic train. Wall Street acted on this at once. The stock shot up from 12 to over 20. By the time I heard this startling information, the stock had risen to what later turned out to be its peak. Another time, my broker called me and said, Sterling Precision will go to 40 before the end of the year. The stock was quoted at 8. He gave me the reason: the company is buying up many more small prosperous companies and will grow into a giant in no time. He added that this was first-hand information. To me, that was sufficient. Why not? A Wall Street broker, who I thought could not possibly be wrong, had favored me with this authentic news. I could not give my buying order quickly enough. I decided, in view of the source of my information, to plunge big on this one. I bought 1,000 Sterling Precision at 7 1/8, paying $8,023.10. I sat back happily to watch it rocket toward 40. Far from rocketing to 40, it began to waver. Slowly it slid downwards. When it looked as though it would fall below 7, something had obviously gone wrong, so I sold the stock at 7 1/8 for $6,967.45. This piece of news showed me a loss of $1,055.65 in a few days. The stock subsequently touched a low 4 7/8. But these losses were more than offset by the great pride I felt in being part of Wall Street, and I constantly searched for new approaches. One day, reading the Wall Street Journal, I saw a column reporting stock transactions by officers and directors of listed companies. When I looked into this further, I found out that, to prevent manipulations, the Securities and Exchange Commission required that officers and directors report whenever they bought or sold stocks of their own company. Now that was something. Here was a way for me to know what the real insiders were doing. All I had to do was to follow them. If they were buying, I would buy. If they were selling, I would sell. I tried this approach, but it did not work. By the time I found out about the insiders' transactions, it was always too late. Besides, I always found that insiders were human too. Like other investors, they often bought too late or sold too soon. I made another discovery. They might know all about their company, but they did not know about the attitude of the market in which their stock was sold. Through these and other experiences, however, certain conclusions began to emerge. As a baby repeatedly hearing the same words starts to learn them, so did I slowly start, through my trading experiences, to discern the outlines of some rules that I could apply. They were, 1. I should not follow advisory services. They are not infallible, either in Canada or on Wall Street. 2. I should be cautious with brokers' advice. They can be wrong. 3. I should ignore Wall Street sayings, no matter how ancient and revered. 4. I should not trade over the counter. Only in listed stocks where there is always a buyer when I want to sell. 5. I should not listen to rumors, no matter how well-founded they may appear. 6. The fundamental approach worked better for me than gambling. I should study it. I wrote out these rules for myself and decided to act accordingly. I went over my brokerage statements, and it was then that I discovered a transaction that gave me a 7th rule and led to the events that immediately followed. I discovered that I owned a stock and did not know it. The stock was Virginian Railway, and I had bought 100 shares in August 1954 at 29 3/4 for $3,004.88. I had bought it and forgotten it simply because I was too busy on the telephone jumping in and out of dozens of stocks, sometimes making as little as 75 cents. Other times frantically calling up about a sliding stock, trying to sell it before it dropped any lower. Virginian Railway had never given me a moment's anxiety, so I left it alone. It was like a good child that sat playing quietly in the corner while I worried and fretted about the behavior of a dozen bad children. Now that I saw its name, after having held it for 11 months, I hardly recognized it. It had been so quiet it had gone completely out of my mind. I rushed to my stock tables. It was standing at 43.5. This forgotten, calm, dividend-paying stock had been slowly rising. I sold it and received $4,308.56. Without any effort on my part, or even anxiety, it had made me $1,303.68. It also made me dimly aware of what was to become my rule number 7. I should rather hold on to one rising stock for a longer period than juggle with a dozen stocks for a short period at a time. But which stock will rise? How to find it by myself? I decided to have a look at Virginian Railway. What had caused its steady rise while other stocks were jumping about? I asked my broker for information. He told me that the company paid a good dividend and had a fine earnings record. Its financial position was excellent. Now I knew the reason for the steady rise. It was a fundamental reason. This convinced me of the tightness of my fundamental approach. I made up my mind to refine this approach. I read, studied, analyzed. I set out to find the ideal stock. I thought that if I really studied the company reports, I could find out all about a stock and decide whether it was a good investment. I began to learn all about balance sheets and income accounts. Words like assets, liabilities, capitalization, and write-offs became commonplace in my vocabulary. For months, I puzzled over these problems. Night after night, for hours after my daily dealings, I pored over the statements of hundreds of companies. I compared their assets, their liabilities, their profit margins, their price-earnings ratios. I thumbed through lists like stocks with top quality rating, stocks the experts like, stocks selling below book value, stocks with strong cash position, stocks that have never cut their dividend. Time and again, however, I was confronted with the same problem. When things looked perfect on paper, when balance sheets seemed right, the prospects bright, the stock market never acted accordingly. For instance, when I carefully compared the financial position of some dozen textile companies, and after much study, decided that the balance sheets clearly indicated that American Viscose and Stevens were the best choices, it was very puzzling to me why another stock called Textron advanced in price while my two selections did not. I found this pattern repeatedly in other industry groups. Baffled and a little disconcerted, I wondered whether it would not be wiser to adopt the judgment of a higher authority about the merits of a company. I asked my broker whether there was such an authority. He recommended a widely used, serious, very reliable monthly service, which gives the vital data on several thousand stocks, the nature of their business, their price ranges for at least 20 years, their dividend payments, their financial structure, and their per-share annual earnings. It also rates each stock according to relative degrees of safety and value. It fascinated me to see how this was done. High-grade stocks whose dividend payments are considered relatively sure are rated AAA, safest, AA, safe, A, sound. Investment merit stocks that usually pay dividends are BBB, best of group, BB, good, B, fair. Lesser grade stocks paying dividends but future not sure, CCC, best of group, CC, fair dividend prospects, C, slight dividend prospects. Lowest grade stocks, DD, no dividend prospects, D, slight apparent value, D, no apparent value. I studied all these ratings very carefully. It seemed so very simple. There was no longer any need for me to analyze balance sheets and income accounts. It was all spelled out for me here. I had only to compare. A is better than B, C is better than D. I was absorbed and happy with this new approach. To me, it had the charm of cold science. No longer was I the plaything of frantic, worrying rumor. I was becoming the cool, detached financier. I was sure I was laying the foundation of my fortune. I now felt competent and confident. I listened to no one. I asked no one for advice. I decided everything I had done before was as slap-happy as my Canadian gambling period. I felt all I now needed to achieve success was to set up my own comparison tables. This I did, spending many grave and serious hours at the task. Chapter 3. My First Crisis. From my reading, I knew that stocks, like herds, indeed form groups according to the industry they represent, and that stocks belonging to the same industry have the tendency to move together in the market, either up or down. It seemed only logical to me that I should try to find through fundamental analysis A, the strongest industry group, B, the strongest company within that industry group. Then I should buy the stock of that company and hold on to it, for such an ideal stock must rise. I started studying the personality of a stock in relation to its industry group. When I read the quotations of General Motors, I automatically looked at those of Chrysler, Studebaker, and American Motors. If I looked at Kaiser Aluminum, my eye automatically glanced afterwards at Reynolds Metals, Alcoa, and Aluminum Limited. Instead of reading the stock tables in A, B, C order, I always read them in industry groups. Whenever a stock started to behave better than the market generally, I immediately looked at the behavior of its brothers, stocks of the same industry group. If I found that its brothers also behaved well, I looked for the head of the family, the stock that was acting best, the leader. I figured if I could not make money with the leader, I would certainly not make money with the others. How delighted and important I felt doing all this. This serious scientific approach made me feel like a soon graduating expert in finance. Besides, I felt this was more than mere theory. I was going to put all this into practice and make a lot of money. I started by compiling earnings of whole industry groups like oils, motors, aircraft, and steel. I compared their past earnings with their present earnings. Then I compared these earnings with the earnings of other industry groups. I carefully evaluated their profit margins, their price-earning ratios, and their capitalizations. Finally, after a tremendous amount of sifting and concentrating, I decided that the steel industry was the vehicle which would make me rich. Having made this decision, I then examined the industry in the minutest detail. Once again, I delved into my rating service. I was determined to play safe, so I figured the stock to buy should be in the A range and should pay a high dividend. But I received a surprise. As I went into this, I discovered that A ratings were extremely rare and were almost always for preferred stocks. They were relatively stable price-wise and rarely rose spectacularly. Obviously, these were not for me. I decided to look at the B range. Here the stocks looked fine, and they were numerous. I selected the 5 best known of them and started to compare them with each other. I did this with the utmost thoroughness. I set up my comparison table like this. Company, Bethlehem Steel. Rating, BB. Price, end of June 1955, 142 3/8. Price-earnings ratio, 7.9. Earnings per share, 1952, 8.8. 1953, 13.39. 1954, 13.18. Estimated 1955 earnings, 18. Dividend, 7.25. Company, Inland Steel. Rating, BB. Price, end of June 1955, 79 3/8. Price-earnings ratio, 8.3. Earnings per share, 1952, 4.85. 1953, 6.9. 1954, 7.92. Estimated 1955 earnings, 9.5. Dividend, 4.25. Company, U.S. Steel. Rating, BB. Price, end of June 1955, 54 3/8. Price-earnings ratio, 8.4. Earnings per share, 1952, 2.27. 1953, 3.78. 1954, 3.23. Estimated 1955 earnings, 6.5. Dividend, 2.15. Company, Jones & Laughlin. Rating, B. Price, end of June 1955, 41.5. Price-earnings ratio, 5.4. Earnings per share, 1952, 2.91. 1953, 4.77. 1954, 3.8. Estimated 1955 earnings, 7.75. Dividend, 2.25. Company, Republic Steel. Rating, B. Price, end of June 1955, 41.25. Price-earnings ratio, 8.5. Earnings per share, 1952, 3.61. 1953, 4.63. 1954, 3.55. Estimated 1955 earnings, 5.5. Dividend, 2.5. As I looked at my table, I began to feel a wave of excitement. My table, like a pointer on a scale, clearly pointed to one stock, Jones & Laughlin. I could not imagine why no one else had noticed it before. Everything about it was perfect. It belonged to a strong industry group. It had a strong B rating. It paid almost 6% dividend. Its price-earnings ratio was better than that of any other stock in the group. A tremendous enthusiasm came over me. This undoubtedly was the golden key. I felt fortune within my grasp like a ripe apple. This was the stock to make me wealthy. This was a gilt-edged scientific certainty, a newer and greater Bryland. It was sure to jump 20 to 30 points any moment. I had only one great worry. That was to buy a large amount of it quickly before others discovered it. I was so sure of my judgment based on my detailed study that I decided to raise money from every possible source. I had some property in Las Vegas, bought out of many years of work as a dancer. I mortgaged it. I had an insurance policy. I took a loan on it. I had a long-term contract with a Latin Quarter in New York. I asked for an advance. I did not hesitate for a moment. I had no doubts. According to my most scientific and careful researches, nothing could go wrong. The 23rd of September, 1955, I bought 1,000 shares of Jones & Laughlin at 52.25 on margin, which at that time was 70%. The cost was $52,652.30, and I had to deposit $36,856.61 in cash. To raise this amount, I had to put up all my possessions as a guarantee. All this I had done with the greatest confidence. Now there was nothing to do but sit back and wait until I would begin to reap the harvest of my foolproof theory. On September 26th, the lightning struck. Jones & Laughlin began to drop. I could not believe it. How could it be? This was the new Bryland. This was going to make my fortune. It was no gamble. It was a completely detached operation based on infallible statistics. Still, the stock continued to drop. I saw it fall, and yet I refused to face reality. I was paralyzed. I simply did not know what to do. Should I sell? How could I? In my projection, based on my exhaustive studies, Jones & Laughlin was worth at least $75 per share. It was just a temporary setback, I said to myself. There's no reason for the drop. It's a good, sound stock. It'll come back. I must hold on. And I held on, and I held on. As the days went by, I became afraid to look at the quotations. I trembled when I telephoned my broker. I was scared when I opened my newspaper. When after a 3-point drop in the stock rose a half a point, my hopes started to rise with it. This is the start of recovery, I said. My fears temporarily calmed. But the following day, the stock resumed its downward slide. On October 10th, when it hit 44, blind panic set in. How much further would it drop? What should I do? My paralysis turned to terror. Every point the stock dropped meant another $1,000 loss to me. This was too much for my nerves. I decided to sell, and my account was credited with $43,583.12. My net loss was $9,069.18. I was crushed, finished, destroyed. All my smug ideas about myself as the scientific Wall Street operator crumbled. I felt as though a great bear had shambled up to me and mauled me just when I was preparing to shoot it. Where was the science? What was the use of research? What had happened to my statistics? It would be difficult for anyone to conceive the shattering effects of the blow. If I had been a wild gambler, I could have expected such a position. But I had done my best not to be one. I had labored long and hard. I had done everything possible to avoid a mistake. I had researched, analyzed, compared. I had based my decision on the most trustworthy fundamental information. And yet the only result was that I was wrecked to the tune of $9,000. Black despair filled me when I realized I would probably lose my Las Vegas property. The horror of bankruptcy stared me in the face. All my confidence, built up by a benevolent bull market and by my first quick success with Bryland, deserted me. Everything had been proved wrong. Gambling, tips, information, research, investigation, whatever method I tried to be successful in the stock market had not worked out. I was desperate. I didn't know what to do. I felt I could not go on. Yet I had to go on. I must save my property. I must find a way to recoup my losses. For hours every day, I studied the stock tables, feverishly searching for some solution. Like a condemned man in a cell, I watched all the active stocks to see if they offered any escape. Finally, my eye noticed something. It was a stock I had never heard of, called Texas Gulf Producing. It appeared to be rising. I knew nothing about its fundamentals and had heard no rumors about it. All I knew was that it was rising steadily day after day. Would it be my salvation? I didn't know, but I had to try. Much more in despair than in hope, as a last wild attempt to recoup my losses, I gave an order to buy 1,000 shares at prices ranging between 57 1/8 and 37 1/2. The total cost was $37,586.26. I held my breath as I anxiously watched its continued rise. When it hit 40, I had a compelling temptation to sell, but I hung on. For the first time in my stock market career, I refused to take a quick profit. I dared not. I had that $9,000 loss to make up. I telephoned my broker every hour, sometimes every 15 minutes. I literally lived with my stock. I followed its every movement, every fluctuation. I was watching it the way an anxious parent watches over his newborn child. For 5 weeks I held it, tensely watching it all the time. Then one day, when it was standing at 43 1/4, I decided not to stretch my luck any further. I sold it and received $42,840.43. I had not got my $9,000 back, but I had recovered more than half of it. When I sold Texas Gulf Producing, I felt as if I had just passed the crisis in a long critical illness. I was exhausted, empty, spent. And yet something began to shine through. It came in the form of a question. What, I asked myself, was the value of examining company reports, studying the industry outlook, the ratings, the price-earnings ratios? The stock that saved me from disaster was one about which I knew nothing. I picked it for one reason only. It seemed to be rising. Was this the answer? It could be. So the unfortunate experience with Jones and Laughlin had its significance. It was not wasted. It led me toward the glimmering of my theory.